The ripple effects of the AWS outage and tariffs on markets and consumers, a deep dive. Welcome to a comprehensive analysis of two seismic events shaking up the global economy and financial markets: the massive Amazon Web Services AWS outage and the ongoing impact of U.S. tariffs. Both stories, while seemingly disparate, underscore critical vulnerabilities in our interconnected world, from the fragility of digital infrastructure to the cascading effects of protectionist trade policies. Let's unpack these developments, explore their historical context, and assess their implications for investors and policymakers. The AWS outage, a wake-up call for digital dependency. Imagine the internet as a sprawling city, with AWS as its power grid. When AWS went down recently, it was akin to a citywide blackout. Over 6.5 million outage incidents and 8 million user reports flooded in within hours, as major services, from Hulu to McDonald's to Snapchat, went dark. Even financial institutions like Barclays and Lloyds couldn't access their systems. This wasn't just a glitch. It was a stark reminder of how reliant the global economy has become on a single player. AWS, commanding a third of the global cloud market and generating over $17 billion annually for Amazon, is the backbone of modern digital infrastructure, hosting apps, processing payments, and storing data. Historically, AWS outages aren't new. A notable 7-hour blackout in June 2023 comes to mind, but the scale of this recent disruption, originating from a single error in Virginia, highlights a growing systemic risk. As cloud computing has evolved since the early 2000s, pioneered by companies like Google but dominated by AWS, the concentration of power in a few providers mirrors historical monopolies in industries like oil or railroads. When Standard Oil controlled much of the U.S. energy supply in the late 19th century, disruptions had outsized effects. Today, AWS's dominance poses a similar risk, amplified by the Internet's role as the lifeblood of global commerce. The sector-specific impact is profound. Tech companies, e-commerce platforms, and even traditional industries relying on cloud services faced immediate operational halts. For Amazon, already under scrutiny for lagging in the AI race behind competitors like Microsoft's Azure and Google Cloud, this outage is a reputational black eye. Yet, intriguingly, Amazon's stock didn't tank, perhaps a sign that investors recognize AWS's indispensability, or they're betting on a swift recovery as seen in past outages. Globally, this event raises alarms about digital sovereignty. Countries increasingly reliant on U.S.-based cloud services may push for localized alternatives, potentially fragmenting the internet. For businesses, the outage underscores the need for diversified cloud strategies. Relying solely on AWS is a gamble, much like putting all your savings in one volatile stock during the dot-com bubble. Tariffs, a regressive tax hiding in plain sight. Shifting gears, let's address the escalating U.S. tariff regime, now 6 months into a policy aimed at reducing trade deficits, reviving manufacturing, and raising revenue. Recent tariffs, 35% on Canada, 50% on Brazil and India, and a threatened 100% on China, echo the protectionist fervor of the Smoot-Hawley Tariff Act of 1930, which deepened the Great Depression by choking global trade. Today's tariffs, coupled with specific levies on furniture, kitchen cabinets, and lumber, are already inflating costs for American consumers and businesses. The data is telling. Inflation, which rose from 2.4% to 2.9% post-tariffs, would have been half a percentage point lower without these policies, per recent estimates. Tariff-sensitive goods like toys, TVs, and coffee spiked 10% in August. Retail giants like Walmart, Target, and Home Depot have openly raised prices, confirming what economists predicted. Tariffs are a tax on consumers, not foreign nations. Goldman Sachs estimates that Americans shoulder 60% of the tariff burden, a regressive hit to middle and lower-income households already squeezed by inflation. Historically, tariffs have rarely achieved their lofty goals. The 19th century U.S. relied heavily on them for revenue, a system abandoned for income taxes due to its inequity. Today's policy feels like a step backward, especially when paired with tax cuts under the One Big Beautiful Bill Act that disproportionately benefit the wealthy. The $118 billion in tariff revenue for fiscal year 2025 is real. but it pales against the $4 trillion deficit hole over a decade created by tax cuts per budget baselines. This wealth transfer, from consumers to the government, and indirectly to the affluent via tax breaks, mirrors the Gilded Age's stark inequalities. Sectorally, small businesses and retailers face the brunt, with higher input costs squeezing margins. Home building costs are rising due to lumber tariffs, potentially dampening an already sluggish housing market. Globally, trade tensions with allies like Canada and rivals like China risk retaliation, reminiscent of the tit-for-tat tariffs of the 1930s that spiraled into economic isolationism. Market context and investor sentiment. Amid these disruptions, markets have shown resilience. The S&P 500 logged its best two-day gain since June, with major indices up over 1%, buoyed by easing U.S.-China tensions and strong tech earnings, like Apple's 4% rally on robust iPhone 17 sales. Gold hit its 49th record close this year, signaling investor caution, while Treasury yields dipped, reflecting a flight to safety. Yet, beneath the surface, cracks remain. Amazon stock, trading at a relatively modest 17x EBITDA compared to Apple's 27x or Meta's 19x, reflects Wall Street's skepticism about AWS's AI competitiveness. The tariff-driven inflation threatens consumer spending, a key driver of U.S. GDP, and could pressure retail and consumer goods stocks in the coming months. Practical advice for investors. For investors navigating this landscape, diversification is key. The AWS outage highlights the risk of over-reliance on a single tech giant. Consider exposure to alternative cloud providers like Microsoft Azure or Google Cloud, which may gain share if AWS stumbles further. Hedge against inflation with assets like gold or inflation-protected securities, given tariff-driven price pressures. In retail, focus on companies with strong pricing power or domestic supply chains less exposed to tariffs. Monitor upcoming data releases, such as the September Consumer Price Index, for clearer signals on tariff impacts. If inflation accelerates, expect the Federal Reserve to maintain or hike rates, impacting growth stocks. Balance portfolios with defensive sectors like utilities or healthcare, which tend to weather economic uncertainty better. Conclusion: investment and policy implications. The AWS outage and tariff saga carry profound implications. For Amazon, regaining trust and accelerating AI adoption are critical to maintaining AWS's leadership. Failure could cede ground to rivals, weighing on its stock. Tariffs, meanwhile, risk embedding inflation and business distress, especially for small enterprises, while doing little to achieve stated goals like job creation or deficit reduction. Policy-wise, the U.S. must address digital infrastructure vulnerabilities, potentially through incentives for diversified cloud ecosystems or public-private partnerships. On tariffs, a rethink is overdue. Revenue gains are illusory when weighed against consumer harm and long-term economic inefficiencies. A pivot to fairer tax policies, rather than regressive trade barriers, would better serve equity and growth. Near-term catalysts include AWS's response timeline. If outages persist beyond 24 hours, expect stock volatility. The September CPI data, due soon, will clarify tariff-driven inflation trends. A spike could roil markets. Geopolitical developments, particularly U.S.-China trade talks, will also shape sentiment. Stay vigilant. These intertwined crises remind us that, in a hyper-connected world, localized shocks can quickly become global reckonings.